Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the deceased person, estate, and beneficiary FBAR filing rules. There are many complex issues when it involves deceased persons, estates, beneficiaries, and FBARs. It could take forever to talk about, but we're just going to try to keep it to 5 or 6 minutes here and go over the basics. FBAR is the Foreign Bank and Financial Account Reporting Form. It's required by individuals, trusts, estates, U.S. persons who meet the threshold reporting requirements, generally more than $10,000 in annual aggregate total each year. FBAR reporting involves more than just bank accounts. It includes investment accounts, life insurance, pension, and other items as well. When you have a deceased person, where this becomes a major issue is timing, right? When do you file the FBAR? Do you file it in accordance with the last tax return? Is there also an estate or trust tax return to file along with the decedent's last tax return? And was the decedent in compliance for the prior years? First question you should look at is, did the decedent have accounts, and if so, or foreign accounts, when, right? Did they obtain the accounts in their final year with us, or did they have these accounts for several years beforehand? If so, you're going to have to do a little due diligence and see if they were filed in prior years. Also important is to determine how the decedent how the decedent filed their tax return. Did they use a CPA? Did they use TurboTax or Tax Act? Did they use other tax professional? Sometimes as people get older, assuming the decedent was older, the financial planner provides that type of service if it's a basic tax return, things of that nature. When it comes to the estate and the beneficiary, it gets a little more complicated. The estate's going to start filing in the current year based on the decedent's year of passing, right? But where it becomes an issue is, were the accounts under the decedent's name, or were the accounts transferred into the estate from somewhere else, or was the beneficiary identified on the account beforehand? Or was the beneficiary just placed on the account now for the first time as a result of the decedent passing? These are questions you want to try to get answered before filing the decedent's last tax return and before filing the estate's first tax return. If you don't have that information beforehand, it's not fatal. There are various amnesty programs available to assist taxpayers who have not filed in prior years. It does include estates, so while the decedent is not here, of course, to certify under penalty of perjury, there are other actions that can be taken by the estate administrator and beneficiaries to get that into compliance. There are various different programs to consider. Generally, after someone passes, the voluntary disclosure, VDP, for willfulness is tough. It's tough to have a decedent confirm, or people on the decedent's behalf to confirm that they were willful when they're not here. That seems pretty uncool, right? Unless you have absolute facts. Maybe there is a prior CPA who has an organizer. That organizer shows the decedent put no as to foreign accounts when they knew they had them. So then issues about capacity and all that stuff comes into play. It's complicated. Assuming they're non-willful, you've got your streamlined filing compliance procedures, which is broken down further into the streamlined domestic offshore procedures, streamlined foreign offshore procedures, possibly delinquency procedures if there's no unreported income or change in tax, and reasonable cause. We have lots of free resources available on our main website, goldinglawyers.com. You can always reach out to the firm and schedule a reduced fee initial consultation if you think it's appropriate to your case. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.